Okay, today I want to talk about a topic. We start from double entry method. Okay, so the first point is double entry method is a way to record accounting transaction. Okay, so it will be entered twice. Sorry. So we call it double entry. Okay, it's divided into debit side and credit side. For debit side, we usually call left hand side. For credit side, we call it right hand side. So this is debit side. Oh. This is credit. Okay. So according to this format, we have 5 types of account, sorry, not ledger. So I will draw it one by one. Remember, for the left hand side we call debit. So remember, left hand side debit, left hand side debit, left hand side debit, left hand side debit. Okay, for right hand side we call credit. So right hand side credit, right hand side credit, right hand side credit, right hand side credit. So all left hand side called debit, all right hand side called credit. And we have 5 types. One is assets. Okay, remember the accounting concept. Assets equal to capital plus liabilities. And we also have expenses and revenue. Actually, all accounts belong to these 5 types. And what are the difference between these 5 types is the increase and the decrease the side. When we record asset increase, we record in debit side. When we record decrease in assets, we record in credit side. So it will be the same case for expense. Increase in debit side, decrease in credit side. So this is one part. Okay, so for the others, we just reverse. That means record increase in credit side, decrease in debit side. Increase in credit side, decrease in debit side. increase in credit side, decrease in credit side. Okay, so let's see these examples here. Okay, we have to prepare the T accounts. Okay, so let's see. On January 3, we purchased goods on credit with a list price of 10,000. The suppliers offer a trade discount of 2% for purchase order over 5,000 and a cash discount of 3% for settlement within 10 days after purchases. Okay, so we know that purchase goods on credit. So there are two accounts which will be affected. Okay, so one is purchases. Because we purchase goods on credit, so it is trade receivable. Trade payable. We purchase goods and we haven't paid our money to the creditor, so it's purchase and trade payable. Okay, so for purchases, because we will buy the asset, so it belongs to asset. Trade payable, liabilities. Okay, so we record increase debit, decrease credit, and trade payable increase credit, decrease debit. So because we have 2% of trade discount. Okay, remember trade discount will be calculated when we purchase goods. So the list price is 10,000. For 2%, that is, we have to increase 9,018. So remember, record the date. And for the account, we write down the opposite one. That means in purchases account, we write down trade payable. In trade payable account, we record purchases. Okay, so because for the cash discount, it's used when we pay our debt to the creditor. So we have a note, we have cash discount when we purchase the goods or not. So we just neglect it temporarily. So 7, we repaid the supplier for purchases made on 3rd January by check. Okay, so for this one, we have affected 2 accounts. They are first the bank, because it related to check. Okay, and the other accounts is the trade payable, because we paid to the trade payable. So how much do we repay it? Okay, we have to see. Okay, because on 3rd of January if we paid within 10 days after purchase, we can enjoy cash discount of 3%. Okay, it means that totally we have to pay 9,800, but because we can pay it earlier within 10 days, so we can have enjoy a cash discount for this 9,800. And therefore that means we can pay less than. Okay, so for our bank we only need to pay, because we pay check, so we credit our bank account for this one, and for trade payable. Okay, okay, so how about the discount? Because it's cash discount, we have to record it is discount received. Okay, so discount received is revenue account. So here. So how much we enjoy the discount from our supplier is 3% of 9,800. It's 294. So January 7. Trade. Discount received. Okay, so on 10th, we pay rent by check. Okay, so we have to add a rent account because it's an expense. We paid rent 7,000. So you may see one left hand side, one right hand side. Okay, so 10 rent, January 10th bank. Okay, on 25th of January, we show goods on credit for 12,000. So here we use the sales and trade receivable. So we debit trade receivables, credit sales, and here we write down trade receivable, sales here, January 25. January 25. Okay, so here is the answer of part A, and I hope to use this example to tell you about double entry. Yeah, so for reminder, first you have to identify which two accounts will be used. Second, decide which one account debit, which one account credit. So write down price, date, it's the same, okay? That means on left hand side you write down 3,000, on right hand side you write down 3,000. And for the name of account, write on the opposite account. Just like for sales, you write down trade receivable. For trade receivable, you write down sales. Okay? So I hope you can learn from this. It is the easiest part for accounts. I hope you may remember these figures. Thank you.